Well, we're going to be getting the pre-open rates in just a bit. So for the time being, let's address the markets. Anuj joins us for a quick, view on the trade setup today. Hi, Anuj. Morning.
Morning, Nigel. So clearly, there's a lot of risk factors right now. This global cues, especially the way US market panned out. I think the jobs data, obviously, Prashant would have discussed that. That pretty much locks in a 75 basis point rate hike in November, and maybe even 75 after that. The other point that I want to discuss, which for me is important, is this unseasonal rains in north. That could hurt kharif crop, and that would mean a big inflation pressure going forward. Not immediately, but that's a very big negative which happened over the weekend. So just keep an eye on that. And the rupee, of course, could cross 80 to 75 today. Dollar index at 113. You have the Brent crude at 98, US bond yields inching up. And again, there's no clue on what is going to be the terminal rate. That keeps going up. And that is a big worry. That's why you keep falling on the same news again and again. In terms of setup, it's the buy on dips and sell on rally, which is working beautifully. The market's given you a bit of a range, 16,960 on the downside as per the options data. That would be the first line of defense. So let's see if we actually go there. And 16,818 is sacrosanct support. On the upside, of course, 17,400 to 17,500 is the range in which you have the 20-day moving average. And you have also very well-documented resistance because it was a big support for the market on the way down. So on the way up now, it's big resistance. Also, the options data indicates that that's where the call buildup is. My sense is today in the first half, you'll see a bit of an algo trade where the bank Nifty will be much weaker. IT may see some outperformance. On the bank Nifty, 38,650 will be first line of defense, and 38,000 is very strong support. But in the second half, if the market does not fall a lot, in that case, the bank Nifty could actually reverse. So that could give you a good sort of risk reward. But let's see if the first hour low gets defended or not once we have the gap down.
Okay, Anuj, thanks a lot for that. Well, in pre-opening though, the Nifty is down about 300 odd points. So it looks like it's going to be an ugly start. We'll of course wait by for these rates to settle. But for now, the first trade on names like Tata Motors is in the red, down about 2 odd %. Paytm, by the way, reported very good, a very strong update for the quarter gone by. So Paytm was holding up in the green, up about 0.2%. But some very interesting names. So Atul Auto, of course, has been the talking point. Veteran investor Vijay Kedia has invested in Atul Auto, where there is a total 115 crore investment via preferential issue, out of which Vijay Kedia's contribution is about 100 crores, and the total 58 lakh warrants at a price of 198 rupees each. And of course, Vijay Kedia's shareholding will go up. But the moot point is, what is he looking at to invest such a big sum in the business? Now, Atul Auto, as we all know, is a three-wheeler manufacturing company. They make rickshaws and they do e-rickshaws as well. The sales for them have picked up. They do a lot of passenger carriers as well as commercial vehicle carriers. Now, if you look at the last 6 months, the sales have definitely picked up. In the month of September, the sales have gone up by 20%. And April to September, year to date, the sales are up almost 80%, of course, on a very low base. But Prakash Diwan is with us. I wanted his view on this. Prakash, Atul Auto has struggled for a long time. It's just in the last couple of months, I think, with this entire demand scenario kicking in, the numbers are looking good. But for an investor, how does the risk reward look now?
It's actually at the cusp of a turning point of sorts in terms of its growth trajectory. I mean, it has struggled with some of the segments. The positioning has been very well defined that this is cargo movement, intracity. It doesn't do much of very big vehicles and all. And especially in Saurashtra, near Rajkot and all, where it has started off from, they have a very good market share as well, which is now seen like growing because of the performance of their products. They actually ventured into introducing EVs, which somehow took much longer than anticipated. The capex that they had identified, they ran short of it. So that's where they're kind of ramping up. But they seem to be at a critical stage of turning things around. I mean, whether it's an inflection point, I wouldn't know, because the numbers will have to be weighted to decide on that. But I think it's a great story. Very, very focused management, great product line. It's a bit small and niche. That's why you don't see it and as commonly discussed in the mainstream this thing. But I'm quite positive on it. So it's something which you could allocate a little bit of money to in terms of your overall allocation to auto. And remember, in spite of all these moves in auto, stocks, there's still a lot to go. They've not done anything except for the last 8 months, 12 months or something. But overall, in the last 3 months, they've really been very lackluster. So there's a lot of catch up in terms of valuation, growth, and all of that. And Apple Auto precisely doesn't have too much of supply side issues from the semiconductor side. Given their configuration of technology that they use. So it's kind of well poised if things look up on cargo movements, especially in tier 2 cities in India. They will definitely do well.
Okay, all right, Prakash. Always good hearing your thoughts. Thanks so much for stopping by this morning and discussing a whole host of stocks with us. By the way, guys, the timing of Vijay Kedia's re-entry is interesting. This was one of the big multi-baggers for him. He got in 2005 in single digits. He went down, I think, in multiple hundred. I think 400-500 rupees is when he exited, and now he's making a re-entry. So let's see how things go. Yeah. But this was one of his big
earlier stocks.
Yeah, I mean, it was I think 1,000% returns or whatever he made on this one.
So maybe there's a turnaround coming now.
Maybe,
you never know, because it has seen challenges for a very long time, and now suddenly the numbers are starting to pick up.
There are two things. There are actually three things. One, I mean, we had the Bajaj management with us. They said that they're also introducing electric three-wheelers. They said by January, right? Yeah. Second is the pace of growth in electric three-wheelers is higher than conventional three-wheelers now. I mean, this is the data for the last 3 months. And the number of deals which are happening both in the private market and public market. I mean, people basically scrambling to find the piece of the EV action. And Sonia, you've covered this extensively. We were talking about Blue Smart, that ride-hailing company, right? It's like the Ola, Uber, but only with EV vehicles.
Yes.
And it's part of the listed entity called Gensol. Gensol, which is again gone, I mean, the share's gone absolutely through the roof. Yes. They also did a preferential issue not very far back, I think 2 months ago. So there's almost a scramble going on for a piece of the EV action, which I think is quite interesting. All right, what we'll do is we'll shift gears and focus on the FMCG space, where second quarter earnings, at least from staple companies, looking at commentary, etc., is not looking all that great. We have Abhishek Roy, Executive Director, Institutional Equities at Nuvama Group, who formerly known as Edelweiss Securities, joining in. Abhishek, great to have you with us here. Thank you very much. Is that the broad kind of look in that staples are going to have a pretty tepid kind of quarter? There were a lot of expectations that with commodity prices coming off, it'll provide a margin tailwind, etc. But recent commentary doesn't kind of indicate or point to that. Your sense?
Yeah, thanks. Yes, we do expect profit booking in the staples names around 5 to 7% in the near term. Next 1 month, the results will be weak for most of the staple companies. We still expect Asian Paints and ITC, Pidilite to do much better than the FMCG staples companies. See, FMCG staples companies have seen 3-4 key issues in Q2. In terms of rural demand, still there is no recovery at all. I think only noodles and biscuits is seeing recovery because of down trading. Second aspect is in Q1, if you see, the base was favorable because of COVID in the base. Now that is not there at all. So Q2, the base is normal. Also in Q1, the summer portfolio did really well because of very harsh temperature, which is not the case in Q2 at all. Third point is on the international business. If you see, wherever there is a UK exposure, Europe exposure, clearly margins will be impacted significantly. So such companies will see international margins really come off significantly. So on a margin basis, the question which you asked, I think that was not really a concern expectation in Q2, because there's a lag of 3 months. And of course, a lot of companies have built up inventory in the anticipation that crude will move to 150, 170. But H2 is where we expect. See, HUL has cut prices in soaps detergent. So there is some concern also on that now crude is coming back 13%, rupee at 82. But I think still H2 will be better in terms of margins, but stocks could cool off in the near term.
Okay, what about on Dabur? Your thoughts on the business update and the way forward for the stock?
Yeah, Dabur, if you see in terms of the portfolio, Q1, there was an adverse mix in the base because of very high Chyawanprash honey. Q2, that issue is not there. But on the other hand, fruit juice business saw very strong growth in Q1 because of harsh summer. In Q2, that is not there. So on an overall basis, international business of Dabur will grow faster, but because of the forex and currency translation, there will be lower growth. So Dabur currently will be lower in terms of our pecking order, because if you see commodity-wise also, HUL, Britannia, Godrej will see more expansion in H2 because of the palm oil correction. Dabur, if you see, is very diversified. So Dabur will be slightly lower in pecking order, but in H2, we expect recovery in the rural demand, and there should be some improvement in margins because of the packaging cost.
Yeah, other than that, Abnish, in your coverage universe, what are you most excited about? Which are the names, in terms of earnings potential, valuations, where are you seeing the maximum upside?
Yeah, as I said, near term, there could be 5-7% correction in the staples names. That will be the right time to increase exposure to HUL and Britannia. Britannia is one of the few companies where demand recovery has already started. Apart from that, ITC, Asian Paints will see very strong set of numbers. For Asian Paint, we expect 75% plus kind of a EBITDA growth. That's because the base margins are very favorable. Titan, again, if you see, the commentary was very positive, clearly very strong set of numbers. We were expecting around 10% jewelry growth. They have delivered 18% sales growth in Q2.
Okay, what about GCPL? Of course, Titan's numbers actually looked very good. On GCPL, the commentary was a bit weak for the industry as a whole, but the company says that consumption will improve in the second half of the year. As an investor in the stock, what would you do?
Yes, second half consumption recovery, I think every company is currently expecting that. That will also happen because in H2, the base of the rural really turns favorable. So even if nothing changes, because of base, the growth will come back. Second is in soaps, if you see price cuts have started. The grammage addition has started. So that will also help the volume growth. On the gross margin, my sense is clearly GCPL will see very strong expansion in H2 because palm oil is now almost half. They are flowing back a bit to consumer. Ad spends will go up. So on the EBITDA margins, GCPL may not see much of an expansion because they want to increase ad spend. So net-net GCPL has to be seen more from a one-year perspective. But yes, Indonesia continues to remain a concern for us. But on the India part of the business, Africa part of the business, a lot of the concerns are getting addressed.
All right, Abnish, thank you very much for your time. Great speaking with you. And, good to get that perspective. By the way, Jaiprakash Associates has announced the board has approved the divestment of significant cement business. This is, I think, the cement asset in Madhya Pradesh, which they are now divesting. Board has approved divesting the Nigri cement grinding unit, which is in MP. That is what is coming in. I mean, I don't think the name of the buyer is out yet. We'll, or maybe, this is an approval to divest it, and then we'll get to know who's buying this. We highlighted this as part of our top 10 list with Nimesh earlier today.
You can say we told you so. But I think the important point and why the stock is also rising is because of the debt reduction, right? And Nimesh was telling us what 30,000, almost 28,000 crores of debt on the group books. So of course, some of this will be used to repay that. Yeah, no, they've been in NCLT, the NCLT process, and the expectation is if it's a very strong buyer, Nimesh said a large business group, right? It's a very strong, large buyer. It may help in the sort of expedited NCLT
coming
process.
out of the NCLT process. By the way, it's an interesting case. It's dragged on for so long, no point going back into history. But even the bankers were of the opinion that this is an account which should not be in NCLT. But it's kind of taken its own time, and maybe this will see resolution. So we're talking about from a seller's point of view, but depending on how large this asset is, etc., there may be implications for the industry, for the cement industry as well. We'll wait for the buyer, and perhaps there'll be more then. Sudarshan is with us with his 9-10 calls. Sudarshan, hi. Good morning. What do you have?
Well, if the Nifty holds 17,100, this would be a buy on dips opportunity with a tight stop of 100 points. ICICI Bank is a buy with a stop under 850.
Okay, and just a couple of more calls. Mitesh, what would your big call be at 9:10 this morning?
I'll go with a sell on Godrej Consumer with a stop at 841 for a first target of 800.
Okay, well, Godrej Consumer has been under pressure ever since it came out with its numbers, right? So, talking about numbers, Paytm is the one that's holding up actually in pre-opening because of good Q2 business updates. So, let's find out what's happening there. Abhishek is here to give us the latest. Abhishek.
Well, Sonia, it looks like the average ticket size in terms of disbursals have increased massively. So number of loans disbursed is up 8.5% quarter on quarter. However, value of loans disbursed is up 31.7% sequentially. So calculation shows that the average ticket size might have increased by 21.5% on a sequential basis. The gross merchandise value, that's up more than 62% YOY and about 7.5% sequentially. The average MTU is at 8 crore, up about 6.7% quarter on quarter. However, gross merchandise value with respect to the average MTU comes down to 39,750, which is up 15.6% YOY and just 0.7% sequentially. So in this business update, the loan disbursements, the ticket size, that has increased massively quarter on quarter. Back to you.
Okay, Abhishek, thank you very much for that. All right, what we'll do is we'll also get a quick update on Bandhan Bank. Abhishek, back to you.
Bandhan, it looks like, the loan growth is yet to take off. There's nothing much to write about there. H2 FY23 loan book is slightly or just above FY22 numbers. The overall advances growth is 21.7% YOY and about 2.8% sequentially. There is no significant improvement in collection efficiency given the fact that for the month of September, it's at 97% versus 96% in June. However, it was at 99% in March. So CASA ratio has declined sharply by almost 200 to 250 basis point on a sequential basis, and retail deposit share, that's also seen a sharp decline by about 520 to 540 basis point quarter on quarter. There could be pressure in terms of cost of funds for them in this quarter. Back to you.
All right, Abhishek, thanks a lot for that. Well, that's the opening bell that will ring in just about 10 seconds. It's going to be an ugly start to trade if you're a bull. No two ways about that. The Nifty indicating a cut of 220 points straight at the opening. That's the first tick there for you. 200 points gone on the Nifty now. 17,104 is where we're at. That's a cut of about 1.2% straight at the start of opening. Remember, the 50-day moving average has also been breached at about 17,470. Next level we're watching is the 200-day moving average, which is 16,980. For now, that's being held. Let's talk about individual stocks and what's dragging the market lower. The biggest loser is Tata Motors, post the weakness in JLR's retail sales, down 3.5% for Tata Motors and big volumes piling up over there. Followed by a lot of auto stocks. So there's Hero MotoCorp that's under pressure as well. You have some of these consumption names, Asian Paints. Actually, crude has inched up a lot. So, crude-related companies like Asian Paints are down about 2% The financials are not looking good. The Bank Nifty is down almost 500 points. HDFC Bank, HDFC, IndusInd Bank down about anywhere between 1 to 2%. And then the FMCG names, which in any case have taken a back seat. So HUL is down about 1.5%. I'm very interested to see what TCS is doing ahead of its numbers because it's going into its numbers with a slight amount of caution. The stock is down about 18.5% this year. And now heading into its numbers today, later in the evening, the stock is down about 0.5%. What's in the green? Nothing at all. In fact, all Nifty constituents are in the red, barring something like an Apollo Hospitals perhaps. It's a weak opening, but let's see. The gap down was, I guess, expected. What happens from here on is the big question.
No, absolutely. And I think we need to wait and watch. So 190, a fast-changing screen, at least on the index level. Atul Auto, which of course we've been highlighting, is starting, I think, about 11% higher. So just a couple of news-related ones. That's a 12% pop on Atul Auto. It's come off the day's the opening high. The opening high is 244. It's at 239. The other one is Jayaprakash Associates, which just announced divestment of a cement asset in Madhya Pradesh. That is starting, I think, about 5-6% higher. So usually we don't talk about these names right at the word go, but these are news-related names. What else? Just two more names. Look at Z Entertainment. That was the big news flow with regards to that CCI approval the week before. And it's holding. I mean, it's just under 1% cut. It's not as if it's not an everything down kind of a day. It's discerning. Ambuja Cement is up about 1.25%. There is something like a HBL Power, which did very well last week. It's up another 0.5%. Volumes are strong, and that's the only reason they're being mentioned now. Ease My Trip is up 1.5%. Praj is one of the gainers from last fortnight or so. Praj is up another 1.25%. Kochi Shipyard is up 0.5%. Atul Auto I already mentioned. And that's it. I mean, not very much else. On the downside, I mean, I think there will be, of course, a lot. And we've already gone through a bunch. Adani Green is down 2.6. Indigo is starting about 2.7, 2.8 lower. That's a hit on account of oil being higher. KPIT Tech is down 2.25. Info Edge, you will hear from the Info Edge management a little later, 2.5 lower on that one. IGL is down about 2.5. Sonia, of course, highlighted Tata Motors. It's actually the biggest volume-led loser coming up, almost down 4%. JLR numbers were poor, and there's a JP Morgan downgrade as well. Pyramid Enterprises is starting about 2.6 lower as well. So, enough happening on both sides, but most, of course, on the downside. 5:1 declines to advances ratio right now. 222 lower on the Nifty. Sonia.
I just want to point out on Atul Auto, right? I mean, the stock is up, almost 13% right now.
Yeah.
And just to reiterate, this, as we know, is Vijay Kedia's second investment in Atul Auto. In the year 2005, he bought the stock for 9 rupees. It's 230 rupees right now. And I think at that point in time, he made 5,700% returns on his investment.
Yeah.
And of course, it's one of the few three-wheeler makers. It had a very bad patch, but as they say, you buy when there are challenges, right? And now things are picking up, so it would be very interesting. This is his re-entry into Atul Auto, as Nigel was also pointing out earlier. So that's a big move up today.
Absolutely. We'll see how this one goes. Of course, big winner for him earlier. 11.5 higher now. 223 lower on the Nifty, 17,091. Manish Sundalia is with us, Head of Equities, PMS at Motilal Oswal Asset Management Company. Manish, great to have you with us here. Thank you very much. How are things looking? It's a red screen, but do you think, we've seen this before, right? I mean, stronger data, US equity sell-off, market sell-off, but only to be bought back, bid at lower levels. And the relative outperformance still, we fall less basically. It's not as if the market goes up a lot, but it falls less. Will that texture continue to hold? Manish, you'll have to unmute yourself. Thank you.
Sorry. So India has been a relative outperformer in the overall emerging market space. And, as long as, 20 times or thereabouts, prices to earning multiples on FY23 number holds, I don't see how markets can fall drastically, even in the global backdrop of rising rates and whatever has been happening in the US. So the key monitorable is earnings, and I think anywhere between 850 to 900 EPS on the Nifty. If that holds, I think it's a buy on dips market. No two ways about it, because I think if you look at high frequency indicators, oil has been below 100 for the past 60 days. Inflation is flatlined for most regions of the world. Somewhere it is also declining. No major sector has seen a price increase over the last 40 days. India's PMI is at 55. GST collections at 1.4 lakh crores every month. Realistic assumptions and prognosis by the RBI of 6.7% inflation for India. All in all, I don't think, we have serious red flags as far as India is concerned. So according to me, it's a buy on dips market.
Okay, it's a buy on dips market. So there are no major red flags, is what you're saying. Manish, good morning. How are you approaching some of these spaces that have come out of the woodworks after many years, right? Autos, for example, we were just discussing many large investors buying in, a lot of mutual funds raising their holdings in the auto space. What's happening here? Is this some kind of a structural story? And if yes, what are the key themes that you can still play despite the rally that we've seen?
So I think the biggest tailwind is happening in terms of volumes, and that after a very long time, because volumes are now picking up in a big way. There has been a pent-up demand, and that's getting fructified on the easing of supply side challenges. Quarter on quarter, there has been a fall in raw material costs, primarily steel, aluminium, so it is aiding margins as well. So I think after a very long time, you will see Q2 numbers for automobile companies actually show some robust growth, more on for the OEMs as opposed to the ancillaries. But it's going to be a pickup in numbers, in automobile profit after tax numbers, And that's basically getting reflected in, the stock prices of automobile companies. And I think this rub-off effect will also continue into the third quarter and fourth quarter on the back of whatever we are hearing on the ground, expectation in terms of demand. So that's what's actually changing for the automobile space from being a large underweight. I think this is one of the spaces apart from, let's say, financials, technology. These automobiles would be one of the spaces which will show very good earnings for this quarter. That's what is getting reflected in the stock market.
One of the big winners from last month has been Mazgaon Dock, and guess what? It's back right at the top with the largest volumes, and it's turned, it's come back into the green. Mazgaon Dock at 643, there is a bid, and that's up another 10, 11 rupees. I mean, amazing what it's done. It's up 30%, by the way, in October so far. So just a kind of big mover we've been tracking. Kochi Shipyard is up another 2.5% or so. That is, I mean, these are named Mazgaon and Kochi are relative. Mazgaon, of course, was a relative, not underperformer, but didn't do as much as HAL or Bharat Dynamics, etc. But it's caught up now. Kochi Shipyard, of course, is another one of those. IT, Manish, what's your view? Earnings will start to come through first off the block. Stocks still are have lost quite a bit, although some would say that compared to their 10-year median valuations, they're still expensive. Where do you stand there on IT?
So firstly, on the valuation, as opposed to IT spend globally being a discretionary spend, this time around with the migration to the cloud, etc., it's not entirely discretionary. And a portion of the IT spend which is happening, particularly conversion from legacy systems into digital and all of that, it's more mandatory. If you have to, survive, thrive in your business, you got to make that spend. So, as opposed to past cyclical sort of valuation metrics that one is used to seeing for the IT space, I think the valuations will settle at a higher level than what you would have seen in the last 5 years or so. Secondly, I think everything has got to do with how the deal flows would look like for, the commentary that's going to come out at the end of this quarter. Because next year's business is going to be contingent on what sort of a deal flow pipeline that we are talking about in the case of the IT companies. My sense is that broadly, in the case of margins, we are broadly seeing the bottoming out of margins. If not now, maybe slightly later within the next third quarter or so, because supply side pressures are somewhat easing at the margin. So all in all, if the sector is corrected by, let's say, anywhere between 30 and 50%, broadly the mid caps and the large cap names, you would see that the price earnings growth multiple has moderated significantly. If you're looking at the margin, EBITDA margins actually, bottoming out, then and it's a high quality earnings that we are talking about with 70 to 100%, dividend payouts in terms of PAT. Just to understand how the FY24 numbers are going to look like, that's basically what's going to be watched out for in terms of commentary. Numbers broadly would be all right for this quarter. There's nothing that is going to be worrisome as far as this quarter numbers are concerned. Is everything got to do with how FY24 numbers are going to look like, supply side issues, pyramiding, margins, that in a nutshell would be but I would remain positive on the IT space as a case of a buy rather than a sell. And mind you, we are not even talking about the rupee tailwind. Of course, a lot of that cross-currency headwinds would impact on margins, but all in all, rupee tailwind will be felt after a lag. So no reason to be bearish on IT as a space.
So even if today TCS later in the evening, scales down their margin performance, they talk about the demand trends getting slightly adverse, that wouldn't spook you, right? As a long-term investor, if you're holding TCS, despite the caution, you would continue to keep the faith. Is that correct?
100%. I mean, this is one sector which hardly sees any dilution in capital. It's a free cash flow machine. Of course, if FY24 is going to be wobbly, what about FY25? Because in FY25, you'll have, again, the Fed start to cut rates, etc. And again, discretionary spend would come back. So it's a journey in the overall scheme of things. As far as the IT names are concerned, according to me, this is one of the best sectors to own in a long-term portfolio.
Okay.
What else? What is it? Number 2 after IT as a space where one can hunt for opportunities.
So I think all in all, if you look at the trajectory of earnings growth, it's basically financials, autos, industrials, and consumer discretionary. As opposed to in the past year, you had households actually spending a lot on healthcare. This healthcare spend is basically translating into discretionary spend. So the consumer discretionary, the automobiles as a part of consumer discretionary, IT and financials, and somewhat on the industrial side as well. These are the spaces where one will find the maximum gains. This is the space where valuations and growth would have to be measured, and I think these would be the sectors which will lead from the front as far as market cap increase also is concerned. Defense is also a part of the industrial space. Yeah.
Okay. Now, so 2 points. One, would you name what is your top ideas in defense? And second, on financials, apart from the top banks, right? Are there any sort of smaller, niche focused businesses like a home finance company or something on the gold lending side, or you just want to buy some of the larger, bigger banks?
In a rising rate scenario, when cost of funds are actually moving up, basically it's the banks which have a CASA franchise slightly ahead in terms of the pecking order as opposed to the NBFCs. So, plus the credit growth in the system is pretty decent at double digits now. In spite of rate hikes, 190 basis point, you're looking at credit growth in double digits, more like 13-14% now for the fortnight gone by. CDR ratios are inching more than 70%. So I think the best is going to come for the banks as a space. And from that point of view, I think valuations of large cap banks are very, very conducive. There's high margin of safety out there. So stick with the large cap banks. That is where I would look out for. Retail credit is very strong as opposed to, in the past. So, you have plenty of opportunities in the financial. As far as the defense name is concerned, I think everything is available at a bargain. For ourselves, we are looked at BEL, Bharat Electronics, and HAL in some of the funds. But there's bargains across the board.
Bargains? Okay. I mean, they've done big gains, right, Manish?
So, but you look at Cochin Shipyard, it's still at just about high single-digit prices to earning multiples. Mazagon Dock was available at less than cash value. Yeah. So, that's why it's still a bargain.
Yeah.
Okay. Manish, just one thought on, we were talking about the auto space, right? There's lots happening across the world. So we just had the North American truck sales, which hit record highs. And so many companies have an exposure there, whether it's Bharat Forge, Motherson Sumi, small exposures, but exposure nevertheless. Would that pocket interest you?
We are having a large holding in Bharat Forge, so we have been positive on this name. As opposed to the previous, billing or let's say ordering cycle, this time around in the US, the ordering cycle has been preponed. So that gives you a sense of the demand, and obviously the numbers that have come out has been pretty strong at 50,000 plus. So this time around, the total North America Class 8 truck sales are expected to cross the previous peak. So from that point of view, if let's say for Bharat Forge, if 25% of the automobile business comes from North America, even after moderating high energy costs in Europe, having an impact on margins for the European subsidiaries, I think we're broadly looking at 1,200 crores plus of profits for Bharat Forge at, in this year. And valuations are very, very reasonable. And India's CV business is firing on all cylinders. Let's not forget that. You've seen what the numbers for Leyland and Tata Motors and all of the others, tractor sales are pretty strong. So all in all, again, the component suppliers, particularly on the CV side, are in a sweet spot. So I completely agree with you on that.
All right. We're going to, in fact, take that discussion forward. That's the exact same, thing that we're going to talk about with our next guest who joins in. So thanks, Manish, for being with us. The North America truck sales hit a record high in September, an indication that truck ordering activity has picked up in a big way. Samvardhan Motherson has about 7 to 8% of its revenues that comes from that market. In fact, let's clarify that with Vivek Chand Sehgal, the chairman at Samvardhan Motherson International. Mr. Sehgal, always a pleasure speaking with you. Thank you for joining us. I want to start by asking you about the recent order backlog in North America, which was surprisingly positive after many months. How do you see the demand trends in that market, and how much of your own business comes from there?
North America is about 18% of our turnover. We have 31 facilities and about 27,000 people working in North America. So it's pretty important. Yes, the numbers are good and they're going to be better. So the indications are. But, we're delighted that America is doing well. I think all other countries are a bit weak, but America is doing very well. So that's good news.
Okay. So you said that North America totally is about 18% of your business. Within that, how much comes from the truck and tractor segment? And over there, how is the ordering activity? Because, generally May to September is a lean season, but this time ACT research told us that a lot of the ordering was done in September itself. So how do you see the next 3-4 months shape up?
No, I think there is no reason to doubt the optimism. I think the American market looks strong. It still hasn't beaten August 21, but I think in the coming months, it's going to do better.
Okay, that's on America. I wanted to understand what's happening in Europe because we're hearing that a lot of OEMs are cutting their growth targets now for the full year because of the energy crisis in Europe, because of the supply side shortages. Are you facing challenges there even now? And if yes, could you just throw some light on what's the situation on the ground?
Well, Europe is doing reasonably well. We've just opened 2 facilities in Europe. So the order book is strong, but yes, some challenges are there. There is a lot of thinking as to what's going to happen with the power crisis. I think the government of Europe is very cognizant of the fact that there is going to be a power issue. And you should always remember that when COVID times, the response of the European European countries to the manufacturing problems of their factories which are there was phenomenal. Even before we could apply, we had already got the money into our banks to support the workforce and all that. So I'm not worried about Europe at all. I think that the government is very in sync with the industry. And there are ways and means that they're thinking of ways how they can mitigate all these particular issues. So I'm not so worried about our plants in Europe.
Okay, not too worried about the plants in Europe. But could you help us understand what could the cost impact be, sir, for companies, your own subsidiaries like SMR, SMP, because of the rising energy costs? So on one hand, you have the rising energy costs, but on the flip side, raw material costs are cooling off. So net-net, what could the effect be for you?
I don't make one product, Sonia. So, that manages, we have to really calculate all that. But we produce over 30,000 different components, so it's very difficult to give you an off-the-cuff answer. But again, I'm telling you, the fact that in Europe, especially in Europe, I think the governments are very in sync with what's happening to the factories over there. They are very worried about their people. So they have already got some plan to mitigate this particular thing. That's my feeling, personal feeling.
About 25% of your 2025 revenue guidance is expected to come from the non-auto segment, Mr. Sehgal. So just wanted to understand a little more about that, the progress in several other pockets, whether it's aviation, medical, logistics. What would the trajectory look like?
Thanks, Sonia. The thing is like this. In November, we are going to have the midterm review of our 5-year plan. And we will be sharing it with all the investors and our media and all that. So you just have to wait for another month or so, month and a half, and we will tell you. But yes, the progress is very good. In spite of 2.5 years of the first 5-year plan covered with COVID, please believe me, the progress is very good.
Okay, that's on the non-auto business. But coming back to the main passenger vehicle, the auto business, Wanted to understand what the demand trends are like. You spoke about Europe and how you're not too worried over there. What about markets like China, the US overall, not just North America? Because, we just got some data from Tata Motors where the retail sales for Jaguar Land Rover have seen a dip. In fact, one of the pockets saw even a double-digit dip. The Jaguar business saw a double-digit dip compared to last year. So just wanted your sense of how the luxury auto market is doing in China as well as in the US.
So I think in US and all that, it's a no-brainer. It's doing very well. I think China, they are grappling with some COVID issues, and also there's a Congress going on over there for the appointment of the third term of presidency. So I think there's some disruptions over there for some time. But once this Congress is over and all that, and they solve the problem of COVID lockdowns, etc., I think it's going to become very bad, very, very good, because the people will have huge demand, which is pent-up demand, will come back. Just we have to be patient for a month or so. I think globally, the markets are looking good. The luxury demand cars is doing very well. There's waiting lists of 2 years, 4 years. I mean, it's unheard of. It's unheard of.
Okay, that's great to hear. Finally, then a question on the margin performance as well. I mean, it has been a challenging last few quarters.
We are in quiet period. I cannot give an answer to that.
All right, Mr. Sehgal, we'll leave it at that. Thanks a lot for stopping by and speaking to CNBC-TV18. Appreciate your thoughts. That is Samvardhan Madhasan speaking about the North American truck orders. They say 18% of their business comes from North America, and that market is firing on all cylinders. And they're not too worried about Europe, although there are challenges there. China is also grappling with COVID issues, so some problem pockets for sure. But then, there's a ray of hope in North America.
The North American market needs to fire a little less, right? It'll solve a lot of problems with rate increases, etc. But that's Madhasan for you. 200 points are down on the Nifty, by the way. So it's still there. I mean, there's no great change, or there's no great pullback or anything of that sort. 30 minutes of trade. So still very, very early part of the trading session. We'll take a quick break here. We'll come back and we'll be joined by Hitesh Oberoi at Info Edge to discuss the hiring trends, especially what's happening on tech hiring. And of course, a little bit of the outlook on the company. Later, we'll also be joined by Patanjali Keswani, Chairman and Managing Director at Lemon Tree Hotels, to discuss how business has panned out, how occupancy, etc., is looking ahead.